Hi everyone, I'm Andrew Schultz, Community Manager here at RentPrep. I'm also a licensed real estate broker in the state of New York with over 14 years of experience in the property management and rental property industries. On today's episode, we're going to be talking about 3 formulas that every real estate investor and landlord needs to know in order to be successful. If you don't know the numbers on your current or a potential investment property, you could be setting yourself up for a massive failure without even realizing it, and that's what we're going to try to prevent today. By the end of this video, you're going to have a better understanding of capitalization rate, cash-on-cash return, and debt service coverage ratios. Let's go ahead and dive right in. Before we jump into our segments on the actual formulas that we're going to be looking at, I wanted to spend a minute talking about the spreadsheet that we're working with today. This is a spreadsheet that I developed a couple years back, and you can get a free copy of this over on my website, which is whatsdrewupto.com. From there, you'll be able to download a copy of this spreadsheet in its current form, as well as a companion video showing you how to use this piece of software. Now, the nice thing is I built this out to be able to quickly analyze investment properties, and it already has all of the formulas that we're talking about today built into it. So if you're doing a lot of deal analysis or you're in an active buying mode right now, this is a good spreadsheet to have available to you. Now, this is actually a property that we listed and sold back in 2021. All of the numbers are accurate to this property. Obviously, the address has been changed. And down here, we have the mortgage payment. We'll get to that in just a second, but I did update the mortgage value to be more consistent with a 2023 mortgage versus the 2021 numbers that we did run when we initially ran this property. Now, the spreadsheet is broken up into a couple different sections here, talking about your purchase price as well as the total repairs needed, your actual cash invested in the deal. And actually, let me back up one second. You can see up here, I have the cells color-coded. Yellow cells can be edited, green cells can be edited but don't need to be, and the orange cells should not be edited because every orange cell has a formula in it. And you don't want to edit those formulas or you're going to change the way that the spreadsheet works. So if you do download a copy of this, make sure that you're not changing the formulas or you're going to wind up with a spreadsheet that doesn't work the way that you expect it to. All that being said, we have up here is essentially quick information. Our formulas are up here, things of that nature. Size of the building, including the total number of units. These fields over here can be edited. These fields over here can also be edited, but these actually factor into one of the formulas down below. Net operating income, not including mortgage. We'll go ahead and show you what this formula actually works from. And this formula takes your gross annual income minus all of your yearly expenses with the exception of your mortgage and interest payment. You can see that that's not selected here. That's how you would go about factoring your net operating income. Scrolling down a little bit here to the income box, you can see that we factor in the total rents from a monthly basis, and you can see that this monthly cell is actually just a total of all of these current rent cells, and the yearly cell is just the monthly multiplied by 12. So if we were to change this to, say, 2,500, it would go ahead and automatically update our spreadsheet for us. It also takes into account other incomes from things such as laundry or garage rental, or if you have storage spaces or something of that nature. All of that income can be factored in on the spreadsheet, which gives you a gross annual income number based off of the rents plus all of the other income sources. Scrolling down into the next section, we have our yearly expenses broken out into various categories such as taxes, utilities, vacancy, insurance, management and CapEx, maintenance and CapEx, and management, as well as landscaping and snow removal. Obviously, we do have snow removal here in Western New York. That's just one of the things that we deal with here in a cold weather climate. If you have some other expenses that you're incurring on a yearly basis, you can add those in here as well. And then last but not least, the mortgage payment, which tackles the principal and interest only. Your property taxes are factored into up here, and your insurance is factored into over here, which gives you your total PITI payment, principal, interest, taxes, and insurance. But for this field right here, the mortgage payment field, we're literally only looking at the principal and interest. To figure out what our principal and interest payment is, we've got a mortgage calculator built in here, and we used a purchase price of $155 with an interest rate of 7.25, which seems to be pretty current based on today's date. When we're filming this video, we factored for a 30-year mortgage, and we factored an 80% loan to value. So essentially a 20% down payment with a loan amount of $124,000. We went ahead and updated our loan start date to be the beginning of next month. And you can see that based on that, we have a monthly loan payment of $846 a month. You can see it in this box. You can also see it up here. And obviously we have our yearly loan payment as well, which is just the monthly loan payment multiplied by 12. Now, if you wanted to factor in your monthly tax payments, so for instance, we'll hop back to our worksheet and we're going to say that property taxes are $1,000 a month divided by 12 is $84 a month. We're going to go ahead and say you have a tax payment of $84. That updates your monthly loan payment as well as your yearly loan payment up at the top. It also updates your amortization table to show the property taxes are now being paid on a monthly basis. The nice thing is having an amortization table built in as well gives you the opportunity to see what am I paying in interest, what am I paying in principal on a monthly basis, and you can actually factor this all the way down to the very final payment, and it'll show you what your interest and principal payments are, bringing you down to your $0 balance. So that's just kind of a nice add-on that we have built into the spreadsheet so that you don't have to run somewhere else to figure out what your mortgage payment is going to look like. Now, jumping back to the analysis spreadsheet, you can see that our 10,151 comes from our, let's take that back to 0, comes from our yearly loan payment amount right here. And that's just the principal and interest. You can see that we took the property taxes back out of there and the insurance is not factored in on the loan calculator. Those two values, property taxes and insurance, are factored into on the main spreadsheet. Now we're going to start things off by talking about cash-on-cash return. Cash-on-cash return is a calculation of the total cash earned on the property versus the total cash or equity invested into the deal. So this metric is looked at after your financing, but before your income taxes. So this does include your mortgage in this calculation. Now let's go ahead and jump over to our spreadsheet here. And you can see that we do have cash-on-cash return built into our spreadsheet here automatically. The cash-on-cash return is based on the net income, which is going to be your gross income minus your full estimated expenses, including your mortgage payment, divided by your total cash invested. And in this instance, this cash invested, this $34,000, is coming from the down payment on the property as well as the total repairs needed. Where we came up with this total repairs needed figure is actually from down here in the bottom. I had left some notes. The lower unit was vacant at the time that we wrote this sheet up, at the time that we sold the property. The upper was paying $975. The lower unit had actually just vacated and was paying about $975 as well. And the lower unit needed about $3,000 worth of work as part of the turnover. You can see here mortgage assumptions, 20% down at an interest of, actually it's no longer 3.0, it's now 7.25%. over the course of 30 years. So I'm going to go ahead and just update that note, and that's a free edit field that you can just change as you need to. But going back up to the top here, you can see that the cash-on-cash return on this individual property, based on the purchase of based on the cash invested of 34 divided against your true net income, is going to give you your cash-on-cash return. You can kind of see that formula again there. Cash-on-cash return is going to be your gross annual income minus your estimated expenses divided by that actual cash invested. And just to give you a peek at the formula here, the estimated expenses field does factor in everything in the total yearly expenses, including the mortgage payment. Cash-on-cash return is pretty straightforward. This is typically most valuable in a finance transaction where you're dealing with financing, where you want to factor in that mortgage, as well as the taxes and the insurance on the property. Now let's go ahead and talk about capitalization rate, or cap rate for short. Most people refer to this as cap rate. Cap rate is actually very similar to cash on cash, but it assumes that there's no debt on the property. Your mortgage does not factor into this equation, does not factor into this metric. This metric is largely used by investors who are purchasing properties in cash. Cap rate can also be used to determine a measure of value to price. What I mean by that is a seller wants to see a low cap rate because it means that the property is highly valued, and a buyer wants to see a high cap rate because it means that the property may be undervalued. The most common way to drive a cap rate down is to complete value-add renovation and rehab projects to increase the total property value. So jumping back over to our desktop view here, we're going to talk about the cap rate. And as you can see here, this is typically expressed as a percentage as well. Let's go ahead and look at our formula. It's a little bit more complicated on this one. For the cap rate, it's your net operating income without your mortgage divided by your total investment cost. So we're looking at the total investment cost up here, which is your purchase price plus your rehab costs. We're not actually looking at the actual cash invested here, because in this instance, when you're dealing with a net rate, with a cap rate, you're not looking into the finance end of the deal, which is where the cash on cash would be more useful. So this formula in the spreadsheet is a little bit more complicated. It starts with the sum of F45 to F58, which is essentially all of our yearly expenses minus the mortgage payment, because we're not looking at that here. We're going to take the sum of all those, and from that, we're basically subtracting that from our gross annual revenue. So this is your gross annual revenue minus all of your yearly expenses, including your mortgage, divided by your total investment cost in the property. And again, in this instance, your total investment cost, you're looking at the total of the purchase price as well as the total repairs needed, because we're working off the assumption that there's not a debt load associated with the property in this instance. Cap rate is typically most valuable in cash transactions. A lot of investors are not looking at this if they're buying properties with a mortgage. More often than not, if that's the case, you're going to go back and you're going to use the cash on cash return, because that's telling you how much of how well your money is working for you, essentially. Now let's talk about debt service coverage ratio, or DSCR. This is a metric that's largely used by banks and financing institutions, as well as investors who are looking to leverage their asset in the form of a mortgage, a home equity line of credit, a rehab loan, whatever the case may be. The DSCR basically examines the property's ability to generate revenue specifically to pay for the debts and operating costs of the property. So anything less than a 1.0 means that the property can't even support its own expenses. Most banks like to see at least a 1.15, and some want to see even higher than that. We have seen some banks that have a minimum DSCR of 1.25x or 1.5x even in some instances, depending on the type of deal that's being done. From the bank's perspective, the higher the DSCR, the better their position, because the property can actually afford more expense load before it stops performing altogether. Now we're going to go ahead and jump over to desktop mode here. As you can see, we do have debt service coverage ratio built into our spreadsheet here, and it's factored as the mortgage payment, it's factored as the net operating income, not including the mortgage payment, divided by the mortgage payment. And we're actually going to go back again and double check that net operating income so that you can see that this is the gross annual income minus all of your yearly expenses, with the exception of the mortgage payment. So essentially what this is doing is taking your net operating income minus all of your expenses, but the mortgage, divided by your mortgage, to see how many times over the net operating income can afford to pay that mortgage before you can no longer afford to pay that mortgage, if that makes any sense. So at a 1.27x, what that means is that based on the net income of, call it $13,000, and the mortgage payment of, call it $10,000, the property can essentially afford to pay that mortgage 1.27 times based on the net operating income before you get into a situation where the property can no longer support itself. That's the number that the banks typically look at when they're looking to decide if they want to make a loan on a property or not. And as I had mentioned, a higher debt service coverage ratio means less risk for the bank. And actually, it's less risk for you as well if you think about it, because it means that the property's performing better the higher that number is. One thing that a lot of people don't realize, and this is a little bit of a bonus tip, we actually built a max price purchase calculator right into our spreadsheet here. And essentially, if you know what the net operating income of a property is, in this instance, we're going to say $13,000 because that's pretty close to what we're looking at here. And we know what our desired cap rate is. In this instance, we're going to say 8.2%. It'll actually tell you what your maximum purchase price is. And the way that that is actually factored in is exactly as it says here: net operating income desired by the cap rate expressed as a percentage. This field divided by this field as a percentage gives you your maximum purchase price, which in this instance, if you had a net operating income of 13 grand and you wanted to see at least an 8.2% cap rate, your max purchase price on this property is $158,537. You can actually play with the cap rate here a little bit to see what sort of cap rate how the cap rate will impact your purchase price. You can also play with the net operating income. For instance, if you think that you can get the rents up higher and that's going to reduce your overall it's going to increase your overall net operating income if you can keep your expenses the same, let's say that this property is now generating $15,000 in net operating income at the end of the year. And we're going to go back to that same 8.2% desired cap rate. When the property is making more money, you can obviously afford to pay a little bit more for that same property. So that's something that's worth knowing. It's a nice tool. It's a very quick back of the napkin method for you to determine just how much you can afford to pay for the property based on the metrics that you use inside your business. The one thing I did want to mention here is that I didn't cover what's a good cash-on-cash return, what's a bad cash-on-cash return, what's a good cap, what's a bad cap. We did talk about what's a good and what's a bad DSCR because that's pretty straightforward. But the reason we didn't cover that for cash-on-cash and for cap rate is because that's going to be determined by your unique situation, your individual investment criteria. You're going to have a different level of comfort where you want your cap rates to be depending on the properties that you're buying and the areas that you're buying them in. Obviously, a property that's a little bit more stable is going to have a different cap rate than a property that has a lot more vacancy or has a lot more rehab that's needed or something along those lines. So that's something to keep in mind as well. A good opportunity for you to figure out what your cash on cash and what your cap rate should look like would be to go to an investor meetup and talk to some investors there, see what they're getting based on different neighborhoods where they're investing, talk to real estate agents that have a focus on the investment property realm, and see if you can talk to one of them and get some more information as to what's considered a good versus what's considered a bad or an unacceptable cap rate or cash-on-cash return rate in your individual market and based on your individual investment criteria. So there you have it. There are a ton of formulas that investors and landlords look at all of the time, and we barely scratch the surface, but I think that we covered some of the more important formulas for our industry. Is there a formula that you think that we should have covered? Is there something that's missing on our deal analysis sheet that you think that would be a benefit? Do us a favor and drop us a comment down below and let us know what you think. Don't forget to like and subscribe. I'm Andrew Schultz with RentPrep.com, and we'll talk to you soon.